Hey, it's Liam, and I want to start today with something that I genuinely believe most farmers watching this have not fully heard yet, even though it affects every single farm operation in America filing taxes right now. On July 4th, 2025, Independence Day, a piece of legislation called the One Big Beautiful Bill Act was signed into law, and buried inside that bill are tax changes that are specifically, directly, meaningfully better for farmers than anything the tax code has offered in years. We are talking about a doubled equipment deduction, permanently restored bonus depreciation, brand new deductions that did not exist before 2026, real money, real savings, the kind that shows up on your bottom line at tax time, if you know about them. And that is the problem. The IRS is not going to call you. Your county extension office probably sent one email about it that got buried. And most general tax preparers, the ones who do not specialize in agriculture, may not have fully caught up with what changed. So today I am going to walk you through it. Plain English, real numbers, no tax jargon, because you deserve to know every dollar you are legally entitled to keep. Before I get into the specifics, I want to say something that I say to any farmer I talk to about taxes. Taxes are not just a thing that happens to you at the end of the year. Taxes are a financial management tool. The farmers who treat tax planning as something they do in April, scrambling to pull records together for a deadline, are leaving money on the table every single season. The farmers who treat it as something they plan for throughout the year, who make purchasing decisions, timing decisions, and income decisions with taxes in mind, those farmers consistently keep more of what they earn. The changes I'm about to walk you through are powerful, but they are most powerful for farmers who understand them early enough to act on them before December 30th first. So let's get into it. The first and biggest change, and this one I want you to really pay attention to, is what happened to bonus depreciation. Here is a quick background for anyone who needs it. When you buy a piece of equipment for your farm, a tractor, a combine, a grain auger, an irrigation system, the IRS normally makes you deduct the cost of that equipment gradually over several years. That is called depreciation. The idea is that the equipment has a useful life of many years, so the deduction is spread out over that life. Bonus depreciation was a rule that allowed you to deduct a much larger portion of that cost up front. In the first year, it was a powerful tool, but over the last few years, it had been phasing down. In 2023, it was 80%. In 2024, it dropped to 60%. By 2025, it was heading toward 40%. And shrinking further every year. The One Big Beautiful Bill Act permanently restored bonus depreciation to 100% for any qualifying equipment placed in service after January 19, 2025. New or used, you can deduct the entire purchase price in the first year. Let me make that real with a specific number. You buy a $250,000 tractor. You put it to work on your farm before December 31st, 2026. Under the new rules, you can deduct the entire $250,000 from your farm income this year. Not over 7 years, not over 5 years. This year, all at once. For a farmer in the 24% tax bracket, that is $60,000 in tax savings on a single equipment purchase. $60,000 in 1 year. And here is the thing that makes this even more powerful right now. If your farm has had a difficult income year, which, as we have talked about on this channel before, describes a lot of American farms in 2025 and 2026, a large equipment deduction can bring your taxable income down significantly. In some cases, it can create what the IRS calls a net operating loss, which can be carried back 2 years to offset income from better years or carried forward indefinitely to reduce future tax bills. But I want to flag something important here, because I always want to give you the honest picture. Bonus depreciation is powerful, but it is not always the right move for every farm in every year. If your income is already low, taking a massive deduction right now might deliver less value than you expect. A good farm tax specialist can look at your projected income for this year and the next 2 to 3 years and help you figure out the optimal strategy. Please do not make this decision alone. The potential savings are too significant and too easy to miscalculate without professional guidance. The second change, and this one also has a big number attached to it, is what happened to Section 179. Section 179 is a related but different tool. While bonus depreciation allows you to deduct the full cost of an asset upfront, Section 179 is a direct expensing election with a cap on how much you can claim. Before this new law, that cap was $1.25 million. The One Big Beautiful Bill Act doubled it to $2.5 million. For most small and mid-size farm operations, the Section 179 cap was never really a constraint. But here is why this matters, even if you are not spending millions on equipment. Section 179 has a key advantage over bonus depreciation that a lot of farmers do not realize. Bonus depreciation can create a net operating loss, which sounds like it might be a good thing, but in some situations it can complicate your taxes in ways you did not intend. Section 179, on the other hand, can reduce your tax liability down to zero, but it cannot create a loss below zero. For farmers in certain situations, that limitation is actually a feature, not a bug. It gives you more control over where your taxable income lands. The best approach for most farmers is to use a combination of both, maximizing the right deduction for the right asset at the right time, which is exactly why I keep coming back to the same message. Please work with a tax professional who specializes in agriculture. This is not an area where a general tax preparer who does not understand farm accounting is going to serve you well. Now I want to talk about something that I think is genuinely underappreciated, and it is one of the most farmer-friendly provisions in the entire tax code: income averaging. Farming income is wildly unpredictable. One year, you have an incredible harvest and your income spikes. The next year, drought hits and you barely break even. The year after that, your equipment breaks down and you run a loss. The regular tax system does not handle that kind of variability. Well, if you have one great year, the IRS treats all of that income as if it was earned in a single year, and taxes it at the higher bracket that comes with that income level, even if the previous 3 years were terrible. Farm income averaging, which you do on a form called Schedule J, allows you to spread your current year's farm income backwards over the previous 3 years for tax purposes. If those prior years had lower income, more of your current income gets taxed at the lower brackets that applied back then, instead of the higher bracket from your good year. This is a completely legal, completely legitimate tax strategy that is specifically written into the tax code for farmers and fishermen, and it can save a farmer thousands of dollars in the year of a bumper crop or an especially good livestock market. Yet the majority of farmers I hear about have either never used it or did not even know it existed. If you had a strong income year recently, and cattle farmers in particular may be in exactly this situation right now given what we talked about in our last video, this is a provision worth understanding urgently. I also want to flag something that is new in 2026 specifically, and I want to mention it because it affects a lot of farmers who may not realize it applies to them. Starting in 2026, there is a new charitable deduction available even if you do not itemize. Single filers can deduct up to $1,000 in cash donations to charitable organizations. Joint filers, which covers most married farm couples, can deduct up to $2,000. This is on top of your standard deduction. You do not have to choose between itemizing and getting this benefit. For farmers who donate to their church, their local food bank, their 4-H program, their fire department, this is real money that you may have been leaving on the table for years because you did not itemize. Starting now, you do not have to. And there is another new provision for farmers over 65, A new senior deduction of $6,000 per person over 65 is available beginning in 2026. If you and your spouse are both over 65, that is $12,000 in additional deductions. It begins to phase out at $75,000 of income for single filers and $150,000 for married filing jointly. For a retired or semi-retired farm couple with modest farm income, this provision could meaningfully reduce their tax bill. There is one more thing I want to cover today that I think does not get talked about nearly enough, and that is the special tax treatment for farmers when it comes to estimated tax payments. Most self-employed people in America have to pay their taxes quarterly throughout the year in what are called estimated tax payments. Miss those payments and the IRS charges you penalties and interest. But farmers have a special rule that most people do not know about. If at least 2/3 of your gross income comes from farming, you are not required to make quarterly estimated tax payments at all. Instead, you have two options. You can pay your entire estimated tax in one payment by January 15th of the following year. Or you can wait even longer. File your complete return and pay everything you owe by March 1st with no penalty whatsoever. That is an extra 2 to 3 months of cash flow compared to every other self-employed person in America. For a farm operation where cash flow management is everything, especially in the lean months between planting and harvest, that flexibility is genuinely valuable. And yet, the number of farmers who do not know about this provision and make quarterly payments anyway, tying up cash unnecessarily, is significant. Know your rights under the tax code. They were put there for you. I also want to mention one more thing that I think is worth being aware of, especially for farmers in drought-affected areas. The new law also expanded disaster relief provisions for farmers. Farmers and ranchers who were forced to sell livestock because of drought conditions may be eligible to defer the tax on that income, to push the recognition of that gain into a later year when conditions have hopefully improved. And farmers in federally declared disaster areas have expanded options for claiming casualty losses. If your farm has been affected by flooding, drought, fire, or other natural disasters in recent years, please specifically ask your tax professional about the disaster relief provisions that apply to your situation. This is an area where the details matter enormously and where the right guidance can make a significant difference. Before I give you your action for the week, I want to say something plainly, because I think it needs to be said. The tax code is complicated. What I have shared today is accurate to the best of my knowledge, and I have done serious research to make sure of that. But tax situations are individual. A strategy that is exactly right for one farm can be exactly wrong for another, depending on income levels, asset structures, entity type, and dozens of other variables.
Everything I have talked about today,
the bonus depreciation, Section 179, income averaging, the estimated tax flexibility, the new charitable deduction, the senior deduction, all of it is real, and all of it is available to qualifying farmers. But please, please work with a tax professional who knows agricultural tax law before making major decisions based on any of it. The savings are real, but so are the mistakes if you get it wrong. And if you do not currently have a tax professional who specializes in farm taxes, who knows what Schedule F is without you explaining it, who has worked with farm income averaging before, who understands the nuances of depreciation on livestock and equipment, finding one is worth more than almost any other financial decision you can make for your operation right now. Your state's land-grant University Agricultural Extension Office is a good place to start. Many of them run free farm tax workshops and can connect you with qualified professionals in your area. Here is your one action this week. Write down 3 things: the major equipment purchases your farm has made or is considering making before the end of this year, your income level for this year compared to the previous 3 years, because that tells you whether income averaging might help you, and the name of your current tax preparer. Then ask yourself honestly, does that tax preparer know what Schedule J is? Have they ever talked to you about farm income averaging? Did they mention anything about the new provisions from the One Big Beautiful Bill Act when you filed last year or when you met with them recently? If the answer is no, or if you are not sure, that is important information. The right tax professional pays for themselves many times over. Find one who specializes in agriculture and have that conversation before the year ends. I am Liam, and I want to be clear about something. I am not a tax professional, and nothing in this video should be taken as tax advice for your specific situation. What I am is someone who genuinely cares about making sure farmers have access to the same information that everyone else in the financial world already knows. The tax code has tools in it that were written specifically for you. Use them. If this video helped you understand your tax situation a little better today, share it with a farmer. You know, because tax season comes for everyone, and not everyone has someone in their corner explaining this stuff in plain English. Take care of your operation. Take care of your family. I will see you in the next one.